And good morning, everyone, and welcome to your quarterly update of economic happiness and cheer. I've called this presentation "Nothing Ever Happens," and well, simple reason for that is despite large-scale global conflicts, an upending of the global trading order, fiscal public finance concerns in numerous developed economies, including the US, what we find is markets are up on the year. So the S&P 500 hitting new highs recently, and European equities actually doing even better this year for once. We have seen some rise in borrowing costs in Europe, well, and across the world as well, but particularly in the UK and France, where the politics are a little more difficult. But even so, these are moves that matter if you're a bond trader. They're not really moves that matter in a macroeconomic sense, at least so far. Although, of course, there are risks. One of the reasons I think, well, there are numerous reasons for this, that economists seem to be so much more worried than markets. And one of them, of course, is that people now expect the Federal Reserve to cut interest rates maybe quite aggressively. And that will kick off almost certainly tonight when the US Central Bank makes its first interest rate cut of the year. It cut 3 times last year, but then has been subsequently on pause. And it's because of that I would like, before we go into the UK, I think it's worth pausing to talk a little bit about some of the global issues and the US economy in particular. And the first is, let me stress, and depending on the businesses that you're involved in, you may agree or slightly disagree with this, but the tariff uncertainty has not gone. There is still enormous amount of uncertainty. We know that there are multiple aims of the US tariff policy, everything from the aims on migration and the war on drugs to balancing the US trade deficit, as well as various kind of security objectives, and particularly a bit of China bashing as well. And things have settled a little bit. The EU has done its deal. The UK has done its deal. But as we've seen with the UK seemingly dropping it's the discussions on zero steel tariffs, which was supposed to come through as part of the deal, there's going to be many slips and uncertainties in future, and in particular, more sector-level tariffs to come, the so-called Section 232 tariffs, which will affect industries such as the pharmaceuticals, are still yet to be announced. And you know, Donald Trump likes just causing a bit of confusion, doesn't he? So we're definitely not out the woods here, although I would say relative to when we spoke in June, some of the uncertainties have been resolved, but by no means all. And the other thing that's happening on the tariff front is we're starting to see now a bit of a payback. So the right-hand panel shows the value of US imports early in the year. You can see these soared as US importers front-loaded tariffs. And now we're starting to see the payback from that. That means less exports into the US from China and Europe, other parts of the world, and that is now dragging on GDP numbers and economic activity in places that were that front-loaded a load of their exports to the US. I would say the payback hasn't been quite as marked and as bad as you would have expected, given that surge so far, but it may be more of a more gradual drag through the rest of the year as those inventories are run down. But it's certainly something that's going to slow economic growth in the second half of the year relative to the first half of the year, which, as I'll say when we come on to the UK, was actually pretty decent. Now, the reason the Federal Reserve is cutting is the US economy is starting to slow. It's a bit of a mixed picture. It seems to be doing fine in some ways. The rate of job creation has fallen quite rapidly on some measures in the United States. That is what's spurring policymakers into action. But for now, the consumer side of the economy still seems to be holding up. People are still willing to spend. And so there is a bit of a mixed picture on the data, but some of the key indicators are showing the pace of job creation having slowed quite a lot. The other sort of part of the US's complex picture at the moment is, of course, we are starting to see in certain areas, so audio equipment and household furnishings picked here, starting to see the inflation come through from the higher tariff rates. To be expected, but it does complicate the picture for central bankers, of course, because on the one hand, they've got the Federal Reserve has a dual mandate. On the one hand, it has to shore up employment, which it is reacting to today. And on the other hand, inflation is sort of still got some upward pressure, particularly, of course, from tariffs. And you see that again on the left-hand panel here, which is a survey of firms, what's happening to their input prices. And you can see from that in the US, it's a very different picture to the rest of the world. So those cost pressures still high. Nevertheless, the HSBC forecast for a rate cut from the Fed tonight, and then a couple more cuts after that into next year. That's a forecast we've had for a long time, but you can see, given the recent jobs data, the market is now expecting potentially 3 or 4 back-to-back interest rate cuts from the Federal Reserve. The other question, of course, that's circling around US monetary policy is just how much influence Donald Trump will exert over the supposedly independent Federal Reserve. He has removed one Fed governor and replaced them with someone close to him, although that process is still going through the courts. But the US monetary policy backdrop, the rate cuts is one reason why asset markets have rallied again recently, despite some of these uncertainties and the apparent slowdown of the US economy, which is just beginning. But anyway, let's go closer to home. These charts are probably familiar to you. I think I showed them to you 3 months ago. And I alluded to some of the conclusions a moment ago. Actually, for all the doom and gloom in the UK, it had the strongest growth in the G7 in the first half of the year. So we had, I think, 0.7 growth in the first quarter, followed by 0.2 in the second quarter. Not bad by recent standards. Things flatlined a bit in July, but that was a payback from a pretty decent June. So all good. Have I totally changed since we last spoke? Am I all really upbeat? Well, no, because of course some of that growth that we've seen will have been export front loading, which will start to unwind a little bit. So I don't think we can sustain. We're never going to be able to sustain the pace of growth that the UK saw in the first quarter, but still, it's decent. And actually, if we look at the firm's activity surveys, they are still decent. The services line on the left is the key one, sort of 70% of the UK economy, anything above 50 pointing to expansion. Actually, business in the service sector in the UK, according to this survey, not too bad at all. Manufacturing still suffering, but that's true of many European economies, and also consumer confidence. While you'd never accuse it of being particularly high at the moment, it's certainly well off the lows we've seen over the past few years, and creeping up a little bit in the latest releases. One thing you may notice is that the construction sector in the UK seems to be in a pretty dire spot, at least according to the grey line on the left, and certainly, if we look at residential construction and residential investment, so far the Labour government's plans are not really bearing fruit. In fact, total starts of house building, the red line on the left, actually pretty low, despite the flagship policies and the efforts there. Consumer confidence coming up, as I said, the household picture a little bit better. It's supported by fairly decent income growth. So although I'm going to talk about the labour market in a minute, the official data still show employment growing. Wage growth still quite high in the UK and outpacing, albeit uncomfortably high inflation. That's driving disposable income up, as you can see from the black line on the right. People have more money to spend. They're choosing to save a lot of it. But certainly as interest rates continue their journey down, the incentive to save may become dull, and we should see some continued support for household spending in the economy. But that does depend a bit on how well the labour market holds up. Now, I told you last time that the official labour market data, so important for the Bank of England to make policy, are pretty much disowned by the Statistics Office at the moment. They are unreliable. Nevertheless, they're published every month. We look at them. And what they show, as I say, employment still growing, the unemployment rate rising, but that's largely as a result of people coming from not looking for work, coming to look for work. Various reasons why that might be, and drilling down, a lot of it is people who were caring, a lot of women coming back into the labour market. Maybe that's a demographic thing, maybe it's a cost of living pressure, but we are seeing more people look for work. That's increasing unemployment and the unemployment rate, but actually employment itself on the official measures not falling yet. That being said, you can see vacancies have come down quite a long way. And if we look at some other surveys that aren't the official data, a big imbalance between staff availability and the reports of staff demand. So headcount still very much being not growing particularly according to the surveys, but redundancies remain low as well. So both the anecdote and the data bear out there's not mass layoffs happening, but hiring isn't very strong either, although certainly not in recessionary territory by any stretch of the imagination. It's just a cooling labour market. At the same time as the labour market is cooling, we're not seeing a huge amount of downward wage pressure. It is coming down, and you can see that pay growth in the latest outturns, the black line on the left, has come down a little bit, but it's still pretty high, still too high to be consistent with 2% inflation. That's reflected in unit labour cost, which is on the right. So unit labour cost growth, very important to the Bank of England. If you're a service firm and your labour costs are growing at 6% and you've got pretty much no productivity growth, how can you survive without putting your prices up? And unit labour cost growth is still very high in the UK, and there's also a wedge between unit wage cost growth and unit labour cost growth, thanks largely to some of the tax rises on businesses that took effect in April and were announced last October. So it's that right-hand panel that is so much of concern to the Bank of England. You'd need 4% productivity growth for that to be consistent with raising prices by 2%, and of course we're not seeing anything like that. So the UK still in a bit of a world of its own on labour cost growth. Why is that? Well, there may be various reasons, but one is when you ask businesses in particular, but also consumers, about where they think inflation is going to be in the UK, it's much higher than, say, it is in the Eurozone, and it's much higher than 2% as well. So what's happening is people, presumably those that have jobs, and if they have any degree, despite the weakening labour market, if they have any degree of negotiation power, or firms want to retain them, there's obviously maybe a bit of high inflation expectations creeping into wage and procurement deals. So that may be one factor. Then the other factor may be that if we actually adjust the level of the average weekly wage for the change in the price level over recent years, this is the right-hand panel, we see the black line. So actually, adjusted for the inflation basket, the price level of the UK, wages in real terms have risen 3% from where they were in 2021. But if we instead of adjust by the inflation basket, the price level there, but adjust by a household cost index, which puts more weight on rent and food and energy, actually we're still no better off than we were in 2021. So the point of this chart is to say what people see and feel, what's most visible in terms of how much of your pay packet is going on these essentials in life. The official inflation data may not be telling the full story for a lot of people. Well, it can never tell the full story for a lot of people because it's just an average basket. But I think this is something why you can look at the black line and think, well, things are okay. You look at the red line and you can sort of see why people aren't so happy and still very much concerned about the cost of living. And that means that, again, if you've got any kind of sway with your employer, you're still trying to claw back what you feel you should have gained before inflation really hit in 2022 and 2023. You're trying to claw back what inflation took from you, and that's another thing, maybe keeping those labour costs up for the UK. And all that means that inflation is still uncomfortably high. And one further point, I don't have the slide, but one further point I'd make is because of the high labour costs, margins have really been compressed across firms in aggregate recently. So UK margins, the share of national income going to UK companies is really as low as it's been since the data began in the early 90s. And that means if you've got to try and rebuild, either you're going to go bust or you're going to try and rebuild those margins through higher prices in the future. And that's another concern, and perhaps another thing that is hitting UK inflation. But a key thing that hit UK inflation was the big utility bill rises in April, and you can see that just to the left of the dashed line on the left-hand chart here. That will drop out next April, so you'll see a big drop in inflation as it comes out of the annual comparison. But even then, on our forecast, you've still got underlying and headline CPI inflation well above the Bank of England's 2% target. So the UK does have something of a unique inflation problem at the moment. You see that starkly looking at underlying rates of inflation in the UK and the Eurozone. And of course, all the time that inflation is elevated, it's reinforcing that view that you need a higher pay rise, or if you're on a long-term procurement deal, you need to factor those price rises in. So it's a concern, but the good news is that that hump in inflation should be temporary. It should come down, partly because, as I say, labour market is cooling, and that bargaining power that workers have may diminish or should be diminishing as a result of that. But that concern about inflation, I think, means, unlike the Federal Reserve, which is cutting rates, and the ECB, which has probably finished its rate cutting cycle with policy rates at 2%, the UK policy rate is still at 4%, and I think likely to remain there for some time. Once we get closer to next April and the Bank of England sees those numbers come down, has a bit more confidence that inflation expectations are going to come down, we might see it resume cuts. That's certainly, you can see from the red line that the financial markets expect at least 2 more cuts. I think we'll probably get a few more than that, but again, the general direction is still down, just probably a slower pace than what I was expecting when we spoke 3 months or so ago. So that's the monetary policy outlook, and that's sort of okay, really. A largely straightforward story. The fiscal story is anything but. Now, when we spoke 3 months ago, I talked at length about the fiscal challenges. So whilst I'm going to have to do that a little bit again, I don't propose to go over everything I said. But what I will do again is just go through the backdrop. The right-hand chart, which is the really scary one. If you believe the forecasts made after the budget in March, then UK debt as a public sector debt, government debt as a proportion of national income moves on about, flat lines at about 100%. That's the black line over the next 5 years. And then, of course, as a result of welfare commitment, the triple lock, things like that, and the aging population, it spirals off into the stratosphere from kind of mid 2040s or thereabouts. And that forecast for March 25 is already completely blown out of the water for numerous reasons. The first is the modest welfare cuts that the government have planned have been U-turned on. So basically, trying to get to grips with the welfare budget is impossible. So you can forget about material spending cuts probably. And so the ones that had been planned need now to be put back in that will make the fiscal dynamics worse. Second is we've seen, I'll come on to each of these, we've seen a further rise in borrowing costs. And third, we can probably see some unhelpful revisions to the medium term and longer term economic growth assumptions that the OBR, the fiscal watchdog, include. So it's a triple whammy for Rachel Reeves about to hit her. And there's nothing like hitting someone when they're down, are they? Because it's just more bad news at an already bad time. And those forecasts in March, of course, already included something that's roughly equivalent to what you see on the left-hand panel, which is cuts in real terms spending for pretty much everything except NHS and defence. So already it was going to be hard to deliver, and now there's a new triple whammy coming along to hit her. She's Rachel Reeves, former colleague of mine at the Bank of England, former friend. I wouldn't be her for all the tea in China right now, but there we go. And here's why. Even before we factor in any of that stuff, the UK tax take was basically about to hit a new post-World War II high, so the tax take is already high. I talked last time about how 75% of tax revenues comes from 4 types of tax: national insurance, income tax, VAT, and corporation tax. And according to the Labour manifesto, you're not really going to touch any of those, where she said she doesn't want to touch corporation tax. And she promised not to raise taxes on working people. So you can tax the wealthy. They don't work, do they? Well, anyway, but again, I showed you the panel on the right I showed you last time, which is at 40% of income tax revenue comes from 3% of UK taxpayers. So yes, you can tax the rich, potentially, but the rich are more mobile, as we know. I never do a meeting anymore without someone taking me aside and telling me how their friend is moving to Dubai, or they're considering it, or something like that. And so the tax base is getting narrower. But to put it into perspective, if we add up the deterioration from the U-turns on the welfare cuts, the growth situation, and the higher interest costs, we're probably looking at a £30 billion black hole, or rather we could be looking at a £30 billion black hole for the Chancellor in November. And if you're not going to raise those big if your welfare cuts aren't possible, and you're not going to raise any of the major taxes, which you might, I suppose, what can you do? What you can do potentially is, in the grey area section, is get yourself another 5 to 8 billion by freezing income tax thresholds for another year. So as wages go up, more people are dragged into higher tax brackets. That's so-called fiscal drag, and that's a nice little earner. You can tax the banks. You can resurrect a gambling tax plan. Insurance premium tax is something we hear about. But you can add all those manifesto compliant things. I don't think it'll be called the Rayner plan anymore, but something similar, which includes the freezing of thresholds up to 28. You can add that up, and you don't really get close to 30 billion. So probably my best guess is there'll be another year of tax thresholds. could resurrect the fuel duty accelerator and add tax on fuel duty, or you're left with the unpleasant arithmetic in the middle. And even then, the last time the UK raised the basic rate of income tax was Dennis Healey just over 50 years ago. But even if you were to put a penny on income tax, and can you imagine the stink if you were to do that? That only gets you just over £8 billion. It's a difficult position. Or, of course, you can break your own rules, but that is going to rile the financial markets, and I'll say a little bit more on that in a moment. And all of this comes against a backdrop where the pressures on spending just continue to increase. I showed the chart on the left last time, which shows how defence spending dropped below health spending as a proportion of national income just after the wall came down. And since then, as sort of the two have diverged. But now we're trying to increase defence spending again, but without cutting health and welfare spending. Very difficult. And then the right-hand panel shows the debt interest spending. It's sort of running between 3.5% and 4% of GDP. In fact, it'll be closer to 4 now, given the moves in the market. To put that into perspective, as I said last time, it's more than the education budget you're spending on interest costs. So if you rattle the market as Truss and Kwarteng did, and you see another percentage point go on your long-term borrowing costs, you end up in this awful downward doom loop spiral. So you can't really rattle the markets either. So breaking those promises, even though they're their own rules and they're somewhat arbitrary, wouldn't be a good look at the moment. And this is just a slide to hammer home the growth point that I was just making. This is UK output per hour worked, UK productivity growth since the financial crisis, and this is what the OBI is forecasting in March, and this is what it's previously been forecasting if I add on all the previous forecasts. Immediately after the financial crisis, the assumption was it's going to go back to 2.5%. Then the assumption was it's going to go to 1%. Now it hasn't really, it's averaged 0.5%. So I think this round, the ABR is going to revise. There was an FT story yesterday about this, but I think it's sort of well known in the economics community that they're probably going to revise down their medium-term productivity assumption. You can see why from this chart. And then that just makes life much harder for balancing the books as the sort of low productivity scenario on the right-hand panel shows in terms of the current budget or the gap in spending excluding interest costs. So it's real difficult for her. But as I say, break the rules, and those high borrowing costs, which are already the UK is not comparing favourably with its peers, pays more to borrow for 10 years than others. You potentially run the risk of making things worse. And then, of course, if you're not scared of the market, you're scared of the electorate. The latest opinion polls show if there were an election tomorrow, reform would be within a coin toss of an outright majority. So, it's very easy for me to sit here and set out the challenges. It's not very easy to know what an elected politician can do about it. But I can't leave you like that, can I? So what's the good news? Good news is the UK has used its Brexit freedoms to good effect and negotiate some trade deals recently. Goods trade may be suffering, but the UK's export trade is still quite a nice story. And that's great news. And then on the day that Donald Trump has arrived in the UK, perhaps the greatest news, we were at the front of the queue, and you look at what the UK has on US tariffs, even if those steel tariffs, zero steel tariffs don't seem to be going to happen after all. But the UK is very well protected. You know why? Because I like them. That's their ultimate protection. So in some sense, I can leave you with some pieces of good news. But as regard the fiscal challenges, I discussed them at length last time. We will no doubt talk about them again after the budget in December. It's going to be very, very difficult. The other piece of good news is despite everything, the UK economy had the fastest growth in the G7. Labour market is cooling, but it's not falling off a cliff. And whilst we may see a bit of a delay before the Bank of England next rate cut, I think interest rates should still be on the way down.